Are U.S. assets overvalued or underestimated? Hi, everyone. I'm Maggie Lake, and today I'm talking markets with Erik, a former hedge fund manager and author of YWR Substack. Hey, Erik, it's great to see you again.
Hi, Maggie. Good to be talking with you.
So, we're at an interesting juncture in the markets, and I'm curious to get your thoughts. We've been emailing a little bit, and I've had a series of guests on who are pretty bearish, right? Pretty concerned about a lot of things: US economy, assets, debt levels, a bubble, a speculative bubble, and then a couple others cropping up who are bullish and raising targets. And both of them have compelling arguments. And I think, frankly, some people are a little bit confused about what they should be doing with their money. So, I know you follow all this so closely and write about it on your Substack. So, how are you thinking about the investment landscape here?
Um, so going back to our last chat, just very briefly, it was in the middle. It was timing wise. We spoke in the middle of a lot of chaos and post tariff sell off, and I think we had a good call to that. Actually, this was an opportunity to buy something. Go out, buy something, get on offense. That wasn't good to be selling with the VIX at 40 and all, and that the things would recover. Which has happened surprisingly. And I would say the US has gone up more than I anticipated even back then. But I think the challenge, and if you did that and you're long assets and it feels great, right? And you're glad it worked out. But I think the position a lot of, and actually probably more professional investors than the retail market, is that they were surprised, caught out by the strength of this rally, how fast it happened. Maybe they bought a little bit back, but are still net underweighted, have too much cash, and skeptical, not sure what to do, in a difficult spot because they're underperforming, and it's a painful position. And I think also that the bad news is kind of melting away slowly, right? We've got the these tariffs are kind of getting sorted out. And it's like what are you hanging on to as your big bear case now? As Trump, as Europe gets settled, and hopefully China is the next one. So I think, and then it's also when you're in these positions, it's if you've been a long-term portfolio manager, you don't want to chase, right? It's bad to just chase the thing that's gone up, and the day you buy it, you don't have great conviction. You're doing the wrong thing, and so you're very reactive when it sells off, and then you feel, I've made a bad problem worse by buying it on the highs. And so you're also very disciplined and professional, not that you don't want to do that. So I think the most useful thing for a lot of our colleagues right now is like, okay, surprised me. Market went up more than I thought. I didn't see that coming. What do I do now? Yes, I see that things are maybe less volatile and maybe the world is going to be okay. What could be an interesting thing right now? What could be non-consent? And the good trades are always a little different, right? They always challenge the thinking and the convention, and that's what makes them good trades. So what would be that now, right? What could be a cool setup here? And when I look around at the okay, first of all, most people are bearish, but then even the bulls, where you hear the bullish view, it's often this concept of Project Zimbabwe, or what I call Project Zimbabwe, right? So this idea that the asset markets will go up, but it's just because the Fed is, the government's printing money, and so assets go up in price, just even if things are terrible. And you see this, the biggest expression of this view is to buy gold or Bitcoin. And so sometimes, and I think often people are skeptical about real growth. They'll go, yes, asset prices might go up, but the world is terrible and there's not actually any real growth happening. And so you see that, and you see this in the ratios like gold to copper, or gold to, even though copper is doing a little better, it's still at kind of historic lows. Copper is a real asset that you use in the economy. Oil is another one. Oil has gone nowhere. And so these ratios are at very extreme levels right now. In the crypto space, it's Bitcoin versus Ethereum, right? Bitcoin does nothing. It just sits there as a store of value. Ethereum is like the oil of the internet. It's what you use. And so if you look at the setup, where is the, and if you look at the B of A fund manager survey and you go, what's your outlook about the economy? It's like a 4 out of a 10. It's quite low. People are generally quite bearish on the economy. So I think the interesting thing here is to bet on actually growth happening. That the surprise for the market will be that these growth-related trades, maybe like emerging markets, China continuing to do well, even and the big one that is sitting there is energy, which everyone's underweight energy. It's done nothing. A lot of bulls have capitulated on it. It's tried my patience tremendously, but that's the one that's also sitting there as an interesting, what could work that would surprise people. And I'm sorry, Maggie, I'm going on too long, but I
want to just, I think this is fascinating and really, really useful. And first of all, you can tell that you're talking from experience when you talk about the pain that people are sitting in. You miss
I
that
know
rebound. And part of what makes people nervous is that you will get just people chasing performance because they're going to have their year-end jobs on the line, bonuses on the line. They don't believe, right? They don't think things are good, but they just need to get to that, beat the benchmark. They just need to make up. And so that's part of, I think, why people are nervous. And the other thing is, I think you articulated it really well. They know they can't not chase the momentum. They have to chase the momentum. And this is professionals as well as anyone. No one wants to sell into the strength. That's why you hear melt up, right? Like there's this powerful, whether it's passive, whether it's, fiscal, pushing stocks, but that's why everyone keeps talking about a bubble, because they don't really believe things are good. They just think there's this unrelenting momentum. So they don't want to miss it. They don't want to sell it, but they're like ready with a trigger finger because they don't really believe things are good. So that's a really interesting, I think, way to define what's going on. And it kind of matches up with a lot of what we hear, even if they're bullish or in the bull camp. And I think if I'm understanding you right, it's why you're saying their portfolios are, yes, equity exposure, but barbelling it with like gold and Bitcoin because they think the whole thing's going belly up at some point. And so they want to have that kind of diversification. So you're hearing so much about hard assets. Your trade is like, maybe it's really a bull market. Like maybe there is a bull growth story.
Yes, I think there is a bull story. And just one other little extra wrinkle to the pain of the asset manager is that there's an asymmetry to this whole thing, that if you lose a client money, the market went down and you go down, the market goes down 15% and you go down to 15%. That's explainable, right? And you just say, oh, it's an amazing stock. This is still a great company. It's just 15% cheaper. And if anything, you should be just putting more money in because it's so great. This is a great opportunity. And you live through that experience. But if you sold on the lows and the market goes up and the client gave you money to invest in the stock market and you did not do what you were supposed to do and you missed a ripper of a rally, then you get redeemed. You don't. So that is the class A most painful mistake in asset management, is not losing money. It's missing rallies.
You don't want the Uber driver to beat you on performance.
Then you kind of get redeemed. So that is so going back to this pain, now we're coming into, not there yet, but we're getting close to the fourth quarter, right? So the clock is running out, and fourth quarters are often, it can be different any year, but everyone's aware of the statistics that they generally can do well. So yeah, you're right. There's pain, and there's, like you said, there's a real lack of conviction in anything. So I wanted to just share like my setup for why the growth story can happen to try and make it have conviction. So if you can,
try to explain why it might actually. So I'm all ears. Why do you think, given all the concerns, and I only touched on a few of them, all the concerns out there, why do you think that we might actually see real growth that would benefit earnings?
Yes. So I even forgot an extra point that I was going to say. So let's start just big picture, right? The governments are spending money like they haven't. One by one, I mean, the U.S. runs now 6% budget deficits, and I think the CBO will project them. I think they actually get to 7 because the interest payments keep expanding. So in the GFC, we hit like 6% or 7. I don't remember the exact numbers, but like for a year, and then it we're always going to go balanced. Now we don't even talk about balanced budgets in the US anymore, and we don't even talk about 3%, which was like 6 is the new 3, 6 or 7. So that's kind of interesting. The US is spending a lot of money. And a fundamental concept here is that I have learned from going to Africa, but it's also something as bad as good. Can I tell you the very worst bear case scenario for the entire market would be that the federal government tomorrow decided that they were going to run a balanced budget. In fact, they were going to run a surplus because they wanted to pay down some of this enormous debt. That would be the biggest Great Depression that would collapse the entire stock market. So that's strangely the thing that you would think would be the good fiscally prudent thing would be the worst thing for asset prices. So we get into this weird twisted world where deficits actually, I know you'll hit me with the bond vigilantes later, but fiscal spending is actually very supportive of asset prices because all this money goes into the corporates' profits at one point. U.S. Now, do you remember when Europe used to have the Maastricht Treaty? I mean, they still have the Maastricht Treaty, but Germany was going to haul you in front of Brussels if you ever breached a 3% deficit. And I don't know what the estimates are, but I think it's like 5% across Europe. And now the bigger problem is spending money for NATO, kind of catching up to the US a little bit and trying to get Europe to be a bit more of a growth economy. And so now the whole mentality has changed towards spending more money in Europe, especially in the central. So, okay, biggest economic bloc number 2 wants to spend more money than they ever have before. Now let's go to second largest country in the economy in the world. China is coming out of their financial crisis and trying to stimulate their way out of an epic property crash. So you have 3 of the biggest countries' government spending blocks in the world on the gas in a way they haven't been for years. Let's go to number 2, corporates. We have a revolutionary new technology that's got everybody's imagination booming about, the point is that they're spending money, right? You've got, they're spending money in a way that they never did before. And I kind of look at like these Meta's building data centers in Ohio and Louisiana. And I think these things are like 10 or $15 billion each. OpenAI or Oracle's doing a $50 billion one in Abilene, Texas, right? This is money that would have been like on share buybacks, but it's like getting injected into random rural places in real America, right? Unlike HVAC guys, contractors. This is a lot of money coming from tech into the real world, into infrastructure, all the power and electric grid stuff around this. And there's like a real corporate capex Main Street cycle amount of spending happening on around this record spending around this new technology. And I'm like, there's just a lot of juice going on, right? Then the next one I'll go into, and I'll save I'll save the Godzilla trade for last. The next one is the Fed, right? So all this stuff is going on. The market's at all-time highs. The unemployment rate's near the lows at 4%. Government spending, markets at all-time highs, unemployment fine, economy growing, and now we're probably going to have like 150 basis points of rate cuts when technically the inflation rate is above the target. And my just view on Trump and Powell is that I think Powell is just going to try and get through the next 10 months or whatever it is. I think he's just going to cut rates. Basically, I think this tariffs getting sorted out are a nice setup are a very big relief for Powell, because I think previously, A, he's not at 2%. And then the second thing I think he was worried about is like, okay, what happens if we're having 90% tariffs with China? And like, it's such an unknown, and you don't want to be cutting rates and then there's a big negative surprise on tariffs. So I think to the extent that the tariff situation gets put to bed, it gives him some space to cut rates 100 basis points, take him down to 3.5 or 3, mollify Trump. I think the worst case for him is he does not want to get fired. It's a terrible precedent for the Fed. And I think that just the middle of the road path is cut rates, just quiet Trump, get through the next 10 months, and then let the next guy decide whether it has to be 1 or 2. But I think he can go to 3. The inflation rate is basically fine. The tariffs he has the space to do it. And so I think this is a big thing. Like, we are going to have And you might, and I might not think it's a big thing, but like the macro traders, the CTAs, the computers, they're going to notice this. They're going to go, wow, we have a big Fed cutting cycle going on while the world is growing. I think that's going to kick off a lot of trades. Like, I think there'll be I think there could be a little bit more dollar weakness, not a crash, but I think it's going to be, I think they're going to start going into EM, local currency debt. They're going to go into EM. They're going to be maybe another thing. Think of every sector where you would have said in the past, I like this company, but I'm worried about the maturity wall. I'm worried about some debt they have due in 2027 or something, real estate, cruise lines, airlines, casino stocks. I think this is like, wow, like, that whole thing that we were worried about, all these maturities, all this high yield debt, Fed's cutting rates. And the pushback will be, oh, but the 10 year is just going to go up and you can't control that. But I think the 5 year is going to come down a little bit. So basically, a big thing is about to happen in macro world and in factors and asset allocation, is that we're going to be in a Fed cutting cycle, and a relatively sizable one. So that's going to be positive on top of the government spending, corporate spending. Now we have the Fed cutting rates when it really doesn't need to be, because it's under political pressure to do it.
You got fiscal and monetary stimulus.
Right. And what does Bob Elliott called that? The hack Fed or something like that? Or anyways, it's not great. It's not how the Fed should be working, but it's very stimulative to asset prices. And then the final thing was the Godzilla trade, but it really started with the European banks. And I remember, like, when we thought, oh, like the end of 0%, end of negative rates, end of 0% rates, like what's going to happen to the economy? Isn't the whole thing going to crash at these higher interest rates? And this strange thing I've noticed, because I cover banks, especially the European banks, is I've noticed, so they've expanded their profit margins a lot. And they had already gone through 10 years plus of, after the GFC, there was this long cycle of telling the banks to recapitalize. So tier one ratios went from 6 to 12, 13%. So they spent, the banking sector, especially in Europe, has been in the doghouse for over a decade, building up its capital. And now we have that with this higher spreads, their profitability is much higher, the ROEs are much higher. And so, but they were still bearish. They were making this money, but they're always worried about the economy. But now it's been like 2 or 3 years, and they're sitting there, and they've been spending the money on dividends and share buybacks. But I'm like, the capital is piling up. And if the animal spirits start to switch, which it has with the European governments, right? The European governments are like, we need to spend. They're not talking about, oh, we need to stop asset bubbles. The top-down mentality is to growth. And I think what's interesting is the banks in Europe have more capital they know what to do with. They're more profitable than they've been in, like, pre the financial crisis. And if the biggest thing is that the banking sector wants to lend, it's so bullish for Europe. But then I was looking over at basically in Europe, I calculated that they have about $250 billion of excess capital. It could be that if you lever that up, that's like over $1 trillion in lending. That's like $1.8 trillion in lending, I believe. In Japan, it's the same thing. They're having margins widen like they never have before. And these banks are like, whoa. And they can see, because it's mechanically happening, they're like, look, as soon as that 1 year JGB rolls off next March, I can go and flip it into a 5 year and make 200 more basis points. So they can mechanically see how their profits are going to grow 70% over the next 18 months. It's just the timing of rolling off the 0% stuff and investing in a higher thing, and then just managing the depositors and giving them a few more basis points and making sure that if rates go up by 50 basis points, that you give them 10 and you take 30. So that's how the European banks do it. They're like, oh yes, interest rates are higher and we'll give you a little bit, but it's never, your savings account is never going to reflect the full magnitude of what's happened, right? Because we need to take that and make some money. So my point is, you have another massive liquidity pool building up excess capital that it's going to be needing. And I would say the Japanese are a year behind on this, maybe 18 months, but that is another lending pool that's going to be driving growth and trying to think of things to do with its money. And Maggie, you probably remember the old days of, the 80s boom was, I mean, golf courses in Pebble Beach, like when I'm kind of a stock market junkie and nerd as a kid about these things. And I remember when Japanese banks they were like, it was a huge bubble. And so I'm like, they inflated the price of everything around the entire world. And I don't expect it to be like that again. But I'm like, that's why I called it Godzilla. It's like this monster has died. It crashed with the Japanese, real estate crash, and it slid under the ocean, and it's dead, but it's coming back, and
it's just a monster of money. It's like
it's a monster of money, and it's coming back, and it's going to start breathing liquidity all over the place.
So let me ask you, this is an incredibly global bullish story.
I know.
But I think one of the arguments that we were hearing a lot of was that money is looking for investments, but because of valuations alone, those investments may not be in the US. Maybe it's the rest of the world's turn to flourish. Understandably, but that's going to mean that even if you just at the margins reduce your exposure to the US because everyone's overexposed to the US equity market, that's going to be bad for US equities. So that's why people are expecting it to look toppy, because that money is going to go everywhere else in the world, emerging markets, China, maybe Japan again, Europe, which looked dead, even though that trade didn't work for 15 years. Now's the time. Does that worry you, or does that, because that would still mean the global economy is bullish, just not maybe.
Yeah, I mean, it kind of makes sense, right? You'd think of like it as a pot of money, and if it's going to go out of the one pot into the other one, and so the U.S. should go down. But then I go, okay, but maybe it doesn't really work like that, because the U.S. is up, the Nasdaq is up, the Europe is up, China's up, Japan is up, gold is up. I mean, everything's up.
So it's like a growing pie. It's not
I wouldn't be selling my U.S. stuff. Maggie, I don't even know what to do. I don't have any cash. I'm long everything. I'm long Asia. I'm long Europe. I'm long Korea. I write on my YWR new ideas, and people say, "Oh, are you buying this?" I said, "I don't have any money to buy it. Ideas keep coming out of my head, and I run out of money to do them." So I think
they all keep. Well, this is a really interesting point, though, because it's more of a scarcity mindset that it must leave the U.S. and go someplace else. But you're saying if there's all this increased liquidity, it can go everywhere. Maybe more goes there, but it doesn't mean it gets sucked out of the U.S. to do that.
No, I don't think that. I mean, no, we'll go to the no, I'm not selling anything in the U.S. I do agree that on a new money. So we started this by thinking where is the new money? What's most attractive? It is the new money. It is the and I'd say Europe was the easiest thing for people to diversify into, right? It's kind of, and so that has gone up a lot. And I'm not selling it, but the idea has crossed my mind is like, well, how much farther does this go? And it's still not expensive and fine. I'm not selling it, but I was like, look, it's come a long way. And so where are the more interesting things? I've actually been looking at, like when I did that Godzilla trade, I was looking at what I was really looking at. Was not really as much the Japanese banks, because they've actually done very well as well. But I was like, okay, so where are they going to spend that money potentially? Once the bear scenario is they just spend it on share buybacks and dividends, and they don't actually grow the balance sheet at all. But where they actually have been buying franchises, both Sumitomo and Mitsui have been buying banks in Thailand, in Vietnam, in the Philippines, in India. And I'm like, okay, those are markets where I would bet that that's where they're going to deploy capital. And those stocks, I mean, this is weird, Maggie. I've been doing an Asia pivot in my portfolio. I was really long Europe in 2022, and I thought that was this big thing. And it's worked, and Europe has, but I'm like, I'm kind of and I do all this quantitative screening, and I look, where's the earnings momentum? And it's consistently in Asia. It's on my screens, it's always Korea, it's Taiwan, it's Japan, it's China, and the US. So I'm like, so the numbers are just saying, so I've been doing this slowly. I started buying Korea. I was in Vietnam a month ago, and the market was on the lows, and I was like, guys, Vietnam looks awesome. So I didn't have any cash, right? But the Vietnam,
Equities, right? You're talking
yeah,
about equities.
it's like the Van Eck Vietnam ETF. I was like, I don't know, I don't have a brokerage account here, but just buy the ETF. But also Thailand is on the lows, the Philippines is on the lows. So that's kind of, I would say broadly emerging markets. I think I'm really bullish on Hong Kong. That has been working really well, but I still think that is, I shouldn't say these things because I think that is a market that could get mental. Like I've seen it in the past with my own,
Go parabolic,
I've
yeah.
seen that one get frothy, and it's been it's not a prudent thing to say to an investor, but I kind of am waiting
Well,
for
you're
that one.
sharing your thoughts. This is never investment advice,
This is not advice. This is
put
just
on
a
our disclaimer.
crazy right
Right.
guy on his own, like
No, we
dreaming.
put a disclaimer out. You're just kind enough to share your
I'm
sort of
sharing my
framework,
imagination
yeah, and how you're thinking about things. So don't worry
that
about
when the
that. We
Chinese,
understand that.
yes, that
Um,
they are used to investing. They have a proclivity for taking risk, and I think once
mm.
the juices get going in Hong Kong, that market's going to go a lot more.
So interesting. It's been a couple years ago, but I did an event where I talked to all the heads of exchanges of all of those countries, and they're very cognizant of wanting investment flows, of maturing those markets, of catching up to the rest of the world. So if that money comes there, I have a feeling they're going to be keen and ready for it, which is a really
Oh,
interesting setup.
that is that's two of my biggest ones are Hong Kong Exchange and Singapore Exchange. Like let's
Yeah.
just play the gatekeeper as the
Yeah.
money comes.
Yeah, right? That's another
The
angle from the banks. Exactly. So, let me ask you a question. What do you make, you mentioned before really the pain of institutions, and there's been a lot of discussion about the fact that retail went in hard on that downdraft. And we're right, right? They in many ways sort of outsmarted the pros for that period. But we see meme stocks back. We see this, everybody's basically gambling in the stock market. Does that worry you? Is that a sign of froth and concern when it comes to the US market? Or do you think that that is just retail not making it overly complicated and sniffing out a story that others haven't seen?
oh, Maggie, you've hit on a massive thing, and this has been a brain flip for me. Um, I I think it's actually a positive thing what we're seeing, and
Mm,
and this is part of my I said, like I've talked about Project Zimbabwe, where I kind of was in these hyperinflationary environments firsthand, and I was like, oh, wait a second, they crash upwards, the markets do, and actually people are scrambling to protect themselves by buying whatever they can. They're like buying stocks, and I was I read stuff like I actually wrote about this exact
Is it because they want to get out of the currency into
yes.
some kind of asset? Okay, everyone, re-rack Peter Brandt. I just did an interview with Peter Brandt, great technician, been trading markets for 50 years. And one of the main things he talked to me about was thinking about equities as a store of value
Yes.
and protecting purchasing power as opposed to staying in a fiat currency, kind of flipping it around in a way that I don't think everyone always thinks about that. So it's so
Yes.
fascinating you just said that to
Oh
me.
yes, and I was interested because I was in Zimbabwe and I was talking to them. I go, oh, why do you buy that? They're like, oh, they were like, yeah, you buy stocks because that's the only way to save your money, like the only way to protect your. But it's like, what about gold? And because they even mine gold in Zimbabwe, and they're like, I was like, well, that's interesting because that would be our first thought of like, oh, if I'm just bearish and but they were like doing it through stocks, and that was my kind
Mm.
of reset. I was like, oh, stocks actually, what if they are like 30% real growth and companies doing interesting things? What if like they're actually a bit like gold? And what if 70% of these market returns are actually just inflation? And these are just stores of value too, same as gold, same as Bitcoin. Like they have tons of stories, and we get caught up in what the management is doing this, but at the meta level, they're just the same thing. So I
So
was
does that
going,
argue for Mag 7 to continue to go higher
yes,
because it's tested
you know
and it's
what?
liquid and
Yes, and I almost say that. So I'm gonna first to finish the other first part.
yeah.
When I would go back and read about Paris in I think it was 1789 or so, I can't remember the exact year. They had some hyperinflationary thing, and this writer, this historian, was talking about the gambling and the stock market fever in the halls of Paris. And it was like people went from saving and being frugal to speculating on everything. And I'm like, this is totally happening. Robinhood, option day, 1 day trading options, poly markets, sports betting. It's all, spend the budget deficits, cutting the, Fed printing money, spending money we don't have. It's all a gambling mentality and speculation because the underlying currency is losing its value. And so actually I said, you know what? Maybe we should not look at the retail trading as like a contrarian indicator and just go, it's actually confirming that we are in an inflationary, like this is just a crack up. And yes, if you want to check the box, what happens in these things? Okay, the government spends money it doesn't have. Check. The the central bank, and this is in the same way in Zimbabwe. They never raise rate. They never make monetary policies never tight. They'll raise it a little bit, but it's always loose. Oh, check. We're going to cut rates when we shouldn't be. Retail investors speculating. Check. So don't see it as like, I was like, oh, wait a second. Is it a confirmation? Is it actually telling us that this is just reaffirming that it's all happening? And I'd almost, so going back to the final thing, I was like, the crash, like we're always talking about, the market could go down in August or it could, and I'm like, the terrible thing that I saw in Africa was the crash it never comes down. The market doesn't come down. It may go down for a month or a year or whatever, but the crash is up. The crash to the person on the street is that they don't own anything, and a year from now they can't go out to dinner. The crash is not being able to go out to dinner because you can't afford it. The crash is not being able to buy a car because you can't believe how much it was, and that your savings didn't do much, and the price of everything around you went up, and the market went up 3x. That's the real crash.
The crash is the people who do not have access or cannot get access or do not have the money to put into U.S. assets.
Or any asset.
It's a class of people who don't own assets. Everyone else rides that and has a way to sort of put their money in the
safety valve. Yeah, you have you can protect you. But yeah, the crash was the guy on the street who didn't own the stock market in Zimbabwe. That was the real crash.
And the fact that everyone who has a phone can participate, you say that retail participation are those that are sniffing this out somehow. They may not fully understand.
And you know what? I don't know why exactly. The part that I don't really know is why they're getting it so right. I mean, I understand that there is a behavioral thing to, but I'm like, I just go, why did the professionals getting this so wrong and the people that aren't even really thinking about it that much getting it so right? And I don't really know. I know kind of behaviorally,
I think Jared talked about just overcomplicating it, right? So let me ask you a different question. Are professional investors underestimating the Trump administration?
Oh, okay. I don't know about, yes, but this is also the problem. Well, I didn't want to say it, but I think this is also why professional investors are really struggling. And I'm in lots of chat groups, and so I see all the snipey things all day about everything. And I'm going to generalize, but I would say that 60 to 70% of fund managers are not supporters of Donald Trump, or are not wild about him, do not like what he does, don't like his policies, don't like how he acts, how he talks, how he does anything. Okay, so while we have this major crack up going on and all this, and I've painted the picture why I think markets are going, banks are lending, Federal Reserve is relatively loose, and then they are very focused on this political overlay that they don't like the things that the president of the United States is doing. So I think that has really tripped people up, that they they don't like Donald Trump, and it's hard in their head to imagine that the market is going to make new all-time highs, the economy is going to be fine, there's going to be a global boom, and everything's going to work out.
Yeah.
I think that is just and I think that has been a cognitive struggle for hard to say. Like, I think it's because what you had to do is go, look, I don't like what he's doing personally, and I have my views, and I think he should do X instead of Y. But when I pull out and I think macro about this, actually, this market is going to rip on this. And it's hard to like do that, have those two views in your head
Two
at one
brains.
time,
Yeah.
right?
I think you're right. I think there's been a lot of that. And I don't, by the way, for anyone listening, I don't get the sense it's partisan. I just think that, when you based on the past and looked at the path, just like when people say the Fed can never achieve a soft landing, it's almost impossible. I mean, to juggle the challenges and we have a lot of disruption, you can always see what could go wrong. And there's been some, and the execution threw people off. And it created a lot of volatility and but through that I think a lot of people were it was I think a lot of people should say orange man bad, right? Like
Yeah.
this is not going to end well. I can't see a way because the communication devices, the execution, the way that these things are usually telegraphed, that has been very different this time. And so I think a lot of people were on the wrong side of that, have been on the wrong side of that.
And I think they may have exaggerated certain things, like what the effects of tariffs would be on the economy, and just kind of over keyed off of these
Although
issues.
we don't know, right? We have not been in a world where we have higher tariffs in a really long time. So we don't really know what will happen. I mean, the bull case now is that everybody will take a little hit and it'll be okay. But we don't really know, do we?
No, but the one thing when I kind of just did a little bit of work on it, I was like, the actual, like in our day to day, how much money we spend, there's not that much that is buying a new hard good. Like if you go around your day and you like look at your month, like what did you spend money on, your mortgage and your health insurance and kids' schools and food and like there's not the amount of things that was a new TV from China or a new it's actually in the numbers. It's not we kind of say it's become a services economy, and it's true.
Yeah.
It's not.
Oh, that's a really good point. Except, of course, if you're in my situation where everything dies at the same time. So I'm just about. I'm just hitting that. Like, what else could possibly go wrong? So I may
You
feel
need
the
some
impact.
new electronics.
It's super interesting. I want to ask you a little bit. You made it really interesting, and I know that you wrote about ETH as well. And I just want you to flesh out that comment you made before about Bitcoin versus ETH, and again, like people not really grasping onto the growth part of the story because Bitcoin's been where all the action is. Explain to me how you're thinking about that.
Yeah, and we talked about the ratio of copper to gold or gold to oil, and sometimes people call Ethereum the oil of the blockchain, right? And so everyone's kind of bullish on Bitcoin, and that's getting all this attention, and there's treasury companies coming up to buy the equity companies being started to just sit and buy Bitcoin. And also people are bullish about the Stablecoin Act, the Genius Act, and how the US could how stablecoins could become more of a regular accepted thing, and there may be expanded use of stablecoins, and maybe the whole maybe Apple Pay will be with stablecoins, and all these things can happen, right? And I'm like, okay, well, all of that runs on the Ethereum blockchain. So why are we neglecting the kind of foundational asset on which this entire blockchain economy we're positive on is going to run? So I kind of thought, and it's moved a little bit but I thought, you know what? I think Ethereum has lagged. People haven't been paying attention to it. It's all been about Bitcoin. And I'm like, look, if you are looking at stable coins and going, look, I think this is part of a broader picture that blockchain adoption and tokenization of assets and all this stuff is starting to happen. And the US government's kind of normalizing it and saying, yes, we're going to put some rules around this, and it's okay. Because remember with Biden, it was like not okay. And they were suing everybody. And this has been this real 180-degree change. The US saying, wow, this is a brand new technology. It has a lot of potential. And we want to be kind of owning it and dominating it and, benefiting, maximizing the benefits that accrue to the US. And so we're going to start having regulations. We're going to normalize it. You could do this, you can do that. It's amazing how the US is leading on this. But all that widespread usage is going to run on Ethereum. So that's the play. That's the backdoor play on all of this, is like, okay, fine, issue stable coins. I don't care.
Amazing.
It's all going to go, I want to own Ethereum.
Such a good point. It's kind of like a lot of this stuff is hiding right out in the open, but I think because of the mentality, everyone's locked in.
And can I say one asset that we didn't discuss? But the biggest, if you're sitting there and you missed another thing to do with your cash, this is a challenging one, right? But they always are. The thing that stands out in the Merrill Lynch survey, B of A survey, that nobody owns is energy. And everyone's underweight oil. Copper's kind of going up and making new highs. Platinum has rallied. Silver's doing well. Palladium has even rallied, but oil is just sitting there. And it's that going back to that thing where I don't think just general view is I don't think the economy is going to work. I don't think there's going to be growth in the world. There might be inflation, but there's not going to be any growth. No one's going to need oil because, there's no growth. So that is, and I know it's challenging because it has not gone anywhere for a long time. But I'll say, so that's one reason. Like, okay, so I just pitched why possibly we could have a real growth story, and you're going to have a Fed rate cutting cycle, and all the other commodities have been moving. That's the catch-up trade. So but it's the hardest one. I pitched it to lots of people, and they're like no takers on that.
Which again, when that's the case, you always got to pay attention.
And I'm aware because I have owned oil stocks and thought they were going to work for the last 18 months, and they haven't. And I know I'm a broken record on them. So, but just as another kind of thing that encourages me is you could lay out the entire story, and it was like, no, I don't.
Yeah, yeah. And when no one's biting,
What else is interesting besides oil?
So let me ask you two final things. First of all, in this scenario, is there a risk you see? I mean, there are always everything's a probability, but is there some, if you were to worry about something that could sort of blow a hole through this pretty bullish case, is there an area?
I'll say the one that everyone will say, and that is that interest rates go up, right? And that the 10-year goes, this is nonsense. You're spending money you don't have. You're cutting rates when you shouldn't. And the 10-year goes to 6%. Mm. And I came into this year thinking that was my base case, that was going to happen. Mm. And I kind of had this change of mind, and it's not very sophisticated for all the economists out there. But I was sitting there going, okay, so I think the U.S. government is not being very fiscally prudent, and this whole Doge thing lasted
didn't work,
right? A guy poor Elon Musk comes in, tries to cut $50 billion out of $6 trillion or however much we spent. It's not a large amount of money, and the country went insane over $50 billion, which is nothing. I was like, okay. So that should tell the bond market that there's absolutely no discipline. We can't even cut costs for 3 months. And so I thought, okay, that should make the bond market scared. The dollar weakening, I was like, oh, the dollar's weakening, the money's running out of the U.S. and it's going to go, and the foreigners aren't going to buy our bonds, and right? Dollar's kind of gone down. It hasn't been, gone down 10, 15% for some currencies. And the 10 years, I don't know, maybe it went up 20 basis points or something, but it hasn't really moved. And inflation has just kind of been, between 2 and 3% and higher than it should be, but it's not really concerning. And I'm like, okay, so what am I what other bullets do I have?
Just by virtue of the fact it hasn't, you threw everything at it and it didn't happen.
I go and I read Substack or whatever, and everyone's talking about this, right? Oh, the bonds are going to sell off because of the look at the big beautiful bill, how terrible it is, and look at the dollar weakening, and look how how terrible everybody thinks, everyone in Europe hates Trump, and so they're not going to put, the whole world hates us, and so money isn't going to come in. And I'm like, okay, so if everybody knows every bear story about the bond market, and we're all hashing it every 10 seconds on Twitter and Substack and everything else, and it's still not moving, then maybe it's not going, maybe like it's actually going down. I know this is unimaginable, but I'm like, okay, is there some like contrarian view here that actually inflation is going to fall, even though that's not at all what I expected? But I'm just trying to open my mind to a new possibility, because every data point that I thought was going to hammer the market has happened, and it's not budging. I'm like, okay, so what could be the other scenario? Is inflation going to fall? Is the Fed going to cut rates, and actually maybe the 10-year drops a little bit? And, I don't know. But I'm like, it's not, as I said, it's not a scientific thing, right? But I'm like, I don't know. I'm kind of like getting less concerned about it, because I don't know what else bad news to throw at the thing.
Hey, listen, exactly. I mean, you do have to. It's great to ask yourself that question, because it's been the case. All right, let's finish up on something that I was really curious about that I saw, but I haven't had a chance to dig into it myself. You don't have time to get all your thoughts on AI, but you're using it, and you just started some kind of intelligence tool or something. What are you up to with that?
Yeah, I started this thing called YWR Intelligence, and the website's www.ywr-intelligence.world. I always like to do world because we're global. And what I started doing was, and the idea is like, type a ticker anywhere in the world, and it creates for you a 4-page report in 3 minutes. And I apologize that it takes 3 minutes, but what's happening behind the scenes is it's pulling real hard financial data from an API, like the valuations, what's the historical price to sales, what are the comparables to what are the competitors to the company, when's it report, all this kind of like hard financial data. And then once all that data's come in, it goes out to OpenAI, a little bit Claude, but mostly OpenAI. And I say, write the bull case on this stock. And I prompt it, write a bull case that you think investors could be missing. Consider this, there's like 5 or 6 things to consider. Now write the bear case on this stock. Oh, also, analyze the last transcript. 1, what is the language? How does management talk? Are they BSers? Do they give hard targets? Do they use flamboyant language? I was like, that's kind of new. I was like, just give me a tone. Tell me the tone of these guys when they talk. What are the key topics that people are talking about in this conference call? So give me the hard numbers in 3 minutes. Give me the hard numbers. Give me the transcript analysis, top issues. Tell me the bull case on this thing. Tell me the bear case. Tell me the narrative and generally how this fits in the market. And then, spit it out to me as a PDF and on the site. So that's what I think. It's like, if you like really know a stock well, it's kind of basic stuff, right? But it's like, I think if you're like a trader and you see a chart you like or something, or you want to know the stocks in a sector, maybe especially for global stuff where you don't know it as well, like you can just get up to speed, I think, pretty quickly on this.
I love it. Also, I would say, like, if you hear a conversation someplace and somebody mentions a name or somebody's talking about a sector, do a little due diligence before you talk to your advisor, so you can have a really educated conversation about what's happening instead of just sort of throwing a dart, right? Like, because maybe you want to say, maybe I want to be in that sector, but there are a couple different companies. And so,
and I think it's supposed to like be a structured report. Yeah, right? It kind of like brings a lot of things that you should know into into 4 pages, and with the narrative, which is this new thing we can do with AI. We can like, okay, and I'm like, use your imagination on all the data stuff. I'm like, no, I don't use AI, so that's coming in hard coded into a SQL database, right? But I like certain parts of the report, I go, so like use your imagination. That's what you're good at. Put it all together, make a story. Tell me a bear story. Yeah, and it's like
That's so fun.
I think it's a V1 thing that we built, and it's kind of cool. And check it out.
I think it's awesome.
Oh, one thing, if you try it out, don't use an ADR ticker. Don't, like, if it's a thing in Europe, because it doesn't pull the data very well. But
so US only for now.
No, it works for the international stocks, but just use the ticker of the local exchange.
Oh, okay.
So if it's like TSMC, use the Taiwanese ticker, not the year.
Well, I love it because I think we all need to sort of up our game. We say this all the time, and make sure that we're being more proactive and really understanding what we're investing in. Erik, this has been such a fascinating conversation. I'm so
It's
glad you
fun.
reached out. So glad we are able to take the time to do this because I think you gave us a lot of things to think about and sort of challenge us to see whether our
That's our
bias.
job.
Yeah, that's right. That's absolutely right. It's fantastic. Thank you so much. I love this. It was
Thank you,
great
Maggie.
to connect with you. And we, of course, put in the descriptions where you can find Erik's Substack. So, such great fun. Thank you so much.
Thank you.